Tonight we begin with a development that federal regulators had feared, financial analysts had predicted, and banking institutions had quietly prepared for. A regulation that unfolded not over years, but in weeks. Weeks that will reshape how Americans access their money. Weeks that will change the relationship between banks and their customers. Weeks that could leave millions of account holders vulnerable if they fail to act. What the Federal Reserve and Treasury Department announced today crossed a line that consumer advocates had hoped would hold. And when that line broke, major banks did not hesitate. They responded with urgency, compliance protocols, and customer notifications that are now flooding inboxes across the country. If you have a checking account, a savings account, or any deposit relationship with a U.S. financial institution, this story is about you. And what you do in the next 30 days could determine whether you maintain full access to your funds. For 18 months now, there had been signals, not official press releases, not formal congressional testimony, just signals that federal banking regulators were preparing something unprecedented. The Federal Reserve has been cautious, yes, but they have been methodical in their caution. Their moves have followed a certain logic, a rhythm, almost a predictability. But what set off alarm bells on Wall Street this quarter was that the rhythm went silent. Financial analysts who monitor regulatory filings know the indicators. The frequency of closed-door meetings between agency heads, the unusual requests for public comment periods, the sudden hiring of compliance specialists at major institutions, the quiet restructuring of customer service departments. All of that went quiet, and whenever regulators go quiet, it means something is about to get loud. For weeks, banking insiders had been whispering about a coming change, something related to account verification, something tied to the Treasury's ongoing efforts to modernize the financial system. But nobody knew exactly what form it would take. Until today. Early this morning, the Federal Deposit Insurance Corporation released what they described as a comprehensive account verification mandate, including compliance requirements that had not been imposed in over 40 years. These are the kinds of regulatory measures that federal agencies only implement when they are signaling something very specific: a crackdown on financial fraud, a restructuring of deposit insurance protocols, or a fundamental shift in how banks verify customer identities. Banking analysts didn't know which category this fell into, or whether it fell into all three at once. But what they did know was that the federal government was changing its posture on consumer banking. And when regulators shift posture without warning, even by small measures, every financial institution in America pays attention. The new rule, formally titled the Enhanced Account Verification and Compliance Act, requires all federally insured banks to re-verify the identity and contact information of every account holder within the next 90 days. But here's where it gets urgent for you. Account holders have just 30 days to respond to verification requests. Failure to respond could result in account restrictions, frozen funds, and in some cases, mandatory account closure. The advisory issued by the FDIC tonight was not normal. It was not routine. It was not symbolic. It was urgent. Banking officials after emergency board meetings described the new mandate as sweeping, immediate, and, perhaps most importantly, non-negotiable in its enforcement timeline. The regulation was designed to close loopholes in the existing Know Your Customer framework, loopholes that federal investigators say have been exploited by fraud networks, money launderers, and identity thieves. But compliance mandates only work if banks have time to implement them. Banks did not get that time. In fact, the implementation window announced today was among the shortest we've seen in modern banking regulation. Here's what we know. Within hours of the announcement, J.P. Morgan Chase began sending verification notices to customers. These weren't the routine security check emails. These were mandatory compliance requests, notifications that customers must respond to or risk losing access to their accounts. Bank of America followed. Wells Fargo followed. And by this evening, regional banks and credit unions across the country were scrambling to build verification systems that could handle the volume. Tonight, Treasury officials confirmed that the new regulation affects all deposit accounts, including checking accounts, savings accounts, money market accounts, and certificates of deposit that had recently been flagged for what investigators believe was inadequate verification documentation. Banks must re-verify customers before regulators can complete their compliance audits. They must confirm current addresses. They must confirm current phone numbers. They must confirm government-issued identification that matches existing account records. In other words, banks must rebuild their customer verification databases from the ground up. The infrastructure that would have made gradual compliance possible was never built. This is what made the FDIC's warning so urgent. The regulation wasn't just procedural, it was immediate. It represented the kind of mandate that could freeze millions of accounts if left unaddressed. And banks, understanding that fully, responded with force. Not recklessly, not carelessly, but systematically. They didn't wait for customers to call with questions. They didn't wait for the news cycle to explain the changes. They hit send on millions of emails. They launched dedicated verification portals. They staffed call centers for what they expect will be weeks of customer confusion. And here's where the story becomes even more concerning. Financial analysts now believe that the regulation's sudden implementation was designed to test the resilience of American banking infrastructure after years of digital transformation. Regulators wanted to see whether banks could handle a mass verification event without system failures. But instead of a smooth rollout, the opposite is happening. Banks didn't anticipate the volume. They launched verification systems that are already showing strain. Systems so overwhelmed, so backlogged, that even customers trying to comply are facing delays. You don't get the Federal Reserve's attention easily. But today, the banking industry did. Compliance officers speaking with financial media under anonymity described the timeline as punitive, a way to force rapid modernization of outdated verification systems. But customers caught in the middle are paying the price. Their accounts are not frozen yet, but the clock is ticking. Their verification windows are open, but the systems are slow. That bottleneck matters because it shows what happens when regulation moves faster than infrastructure. It shows that account holders cannot afford to wait. They must act now. As reports continued coming in throughout the day, we learned more about the scale of the verification mandate. Major banks reported sending over 40 million verification requests in the first 6 hours, forcing customers to log into portals that were already experiencing slowdowns. Credit unions warned members that verification emails might be delayed by up to a week due to volume, even though the 30-day deadline remains unchanged. Online banks operating without physical branches reportedly saw customer service wait times exceed 3 hours as confused account holders flooded phone lines. This wasn't just a policy update. This wasn't just a compliance memo. This was a system shock. This was infrastructure stress. And infrastructure stress is the one thing banks have struggled to manage since the digital banking boom began. For every efficiency gain they have made, regulators have countered with something that tests their capacity. Today's mandate is the biggest test yet. Remember, banks thought they had years to modernize verification systems. They thought gradual compliance would be acceptable. They thought regulators would prioritize stability over speed. But tonight, the exact opposite is happening. Regulators chose speed. Banks are scrambling. And customers are caught in between with deadlines they don't fully understand. The last time federal regulators imposed verification requirements this sweeping was in the aftermath of September 11th, when the Patriot Act transformed banking compliance overnight. But even then, implementation windows were measured in months, not weeks. Today's regulation is different. It is faster. It is broader. And it affects more Americans than any banking rule in decades. What makes this moment so critical and so confusing is that the regulation happened at a time when the Treasury Department is under political pressure. Consumer advocates want stronger fraud protections. Privacy groups want limits on data collection. Banks want flexibility in how they verify customers. And regulators want to demonstrate that they can respond to emerging threats. The Treasury Secretary is balancing these demands while facing congressional scrutiny over recent banking failures. And when agencies in that position make sudden moves, they're not doing it from comfort. They're doing it from pressure. They're doing it from political necessity. The FDIC's statement, now circulating through banking networks nationwide, was designed to signal that regulators are not willing to accept verification gaps that enable fraud. Officials said plainly that the current state of account verification was inconsistent with modern security standards. That is regulatory language for banks have let this slide for too long, and now everyone pays the price. You don't usually hear that tone from the FDIC unless something serious prompted it. Sources suggest a recent surge in account takeover fraud, cases where criminals gain access to legitimate accounts using outdated customer information, triggered the emergency response. Meanwhile, the FDIC chairman addressed reporters in a brief, pointed statement tonight. He said, "Every American deserves to know their bank account is secure." He said, "Verification is not optional, it is foundational." And he said, "Account holders who fail to respond to verification requests will face consequences. We cannot protect accounts we cannot verify." These are not rhetorical flourishes. These are statements from an agency that understands just how high the stakes have become. Here's what makes the situation even more concerning. The verification mandate wasn't isolated. Along with the account verification requirement, the Consumer Financial Protection Bureau also announced enhanced disclosure requirements for bank fees. The Office of the Comptroller of the Currency issued new guidelines on digital identity verification. FinCEN increased reporting requirements for suspicious account activity targeting high-balance customers. All of this happened within the same 72 hours. When federal agencies move multiple pieces at once, it means something larger is underway. The banking system is being restructured in real time, and account holders are expected to keep up. Financial analysts are now considering several possibilities. One is that regulators are preparing for a broader digital dollar initiative that requires verified account infrastructure. Another is that the Treasury is attempting to close loopholes ahead of upcoming congressional hearings on banking security. A third possibility, the one worrying consumer advocates the most, is that regulators are attempting to shift liability for fraud from banks to customers who fail to maintain updated verification. But today, account holders can take that risk off the table. They don't have to wait for clarification. They don't have to hope their bank contacts them. They don't have to assume they're already verified. They can log in, verify their information, and confirm their accounts are compliant. What we're watching now is a test of consumer awareness. Regulators want to see whether Americans will respond to compliance requirements. Banks want to see whether their systems can handle verification at scale. Consumer advocates want to prevent account holders from losing access to their own money. And fraud networks want to exploit the confusion with phishing emails that mimic legitimate bank verification requests. That last point is critical. Tonight, we've heard from cybersecurity experts who are now monitoring a surge in phishing attempts. They say scammers are already sending fake verification emails designed to steal login credentials. They say consumers should never click links in emails claiming to be from their bank. And they say the safest approach is to log into your bank's website directly, never through an email link, and complete verification through official channels. But legitimate verification is not optional. In fact, legitimate verification is now mandatory. Your response, prompt, verified and completed through official channels, will send a message to your bank that you are paying attention. And it will send a message to regulators that consumers can meet compliance requirements when properly informed. As the coming weeks unfold, we expect more details to emerge about what exactly regulators hoped to achieve with such an aggressive timeline. But what we do know is that the FDIC's action was intentional. It forced banks to prioritize customer communication. It forced compliance systems to modernize rapidly. And it forced consumers to engage with their financial institutions in ways many had avoided for years. What happens next will depend on what account holders do in the next 30 days. If they verify their accounts, this moment will be remembered as a successful modernization of banking security. If they ignore the warnings, banks and regulators have already shown they are prepared to restrict non-compliant accounts. They have shown they are ready to enforce the deadline. And tonight, for the first time in decades, every American with a bank account faces the same question. The deadline is ticking, quietly. And when deadlines are quiet, it means most people aren't paying attention. It means millions will miss the window. Because tonight, regulators made something clear that consumers must understand. Your bank account is not guaranteed. Your access depends on verification, and verification depends on you. This story is far from over. But tonight, one thing is clear. The rules have changed, the deadline is real, and the time to act is now. And we will be here, watching every detail as the next phase unfolds.